Today, folks, we're seeing something unlike anything I've ever seen before in the stock market. A lot of people are making bets right now that something is about to break, and we can see that where they're actually voting with their dollars in specific stocks. We're going to take a look at those stocks that are currently hitting all-time highs. We're going to look at parts of the market that are currently collapsing, breaking. We're going to take a look at Toronto Dominion Bank, which is currently one of the largest shorted banks. We're going to take a look at some of the real estate data, credit card data, and show you why we're living in a double-edged scenario, something like the Twilight Zone. It's not as bad as people would want to think it to be, but there are parts of the market that are pretty devastating, and it's just making this one of the weirdest recessions anyone's ever experienced. I keep hearing that pretty commonly across experienced investors, and if that's a conversation you'd appreciate, hit that like button, folks, because it wasn't even an odd week ago that Michael Burry from the great 2008 financial crisis, the guy that made billions of dollars and who's in that movie, he said I was wrong to say sell. And as soon as he posted this, it's like everyone said, oh my God. It's like the Jim Cramer effect. He says one thing, but another's going to happen. So let's do the exact opposite, because we recently saw gold basically peak its all-time high here. It went well over $2,000 an ounce, maybe not like crazy over, but it's definitely been rallying a lot. You look at utilities right now. Hydro One here in Canada hit an all-time high pretty much this week. You're taking a look at things like Loblaws, these consumer staples, people going to get food. You're never going to give up on that. You're never going to give up on paying your hydro bills. And the Loblaws CEO is definitely not experiencing the recession like you might be if you worked for a big tech company that just laid you off, as his compensation jumped 55% to $8.4 million. So the Loblaws CEO isn't complaining. You look at things like Procter & Gamble here, your toothpaste, your toilet paper, your basic necessities. I mean, this thing's pushing its all-time high. Pepsi, an obvious favorite in the dividend investing community, and I love that the Schwab US Dividend Equity ETF, a favorite holding of mine, really upper weighted Pepsi. Even though I think it's trading at one hell of a premium here, it's starting to push its all-time high. You got things like Walmart getting up there. It's kind of nuts, right? But kind of doing a 180, taking a look at the things that are getting absolutely devastated. It turns out the biggest short in the banking industry anywhere in the world isn't in Switzerland or Silicon Valley, but rather in the relatively tame financial center of Canada, as Toronto Dominion Bank is now short with $3.7 billion on the line, which is kind of staggering. And it's because of the fear of people's exposure, or the exposure that Toronto Dominion Bank has to the Canadian real estate market, the exposure they had to Charles Schwab, that bank that had some devastation to the stock price. I think they own 10% of it or something like that. It's kind of crazy to think that Toronto Dominion Bank is getting dragged down so much because they have this broad banking exposure to the US and Canada. You'd think that would take some concern out of the investors' hearts, and I honestly think these banks are still a huge buying opportunity, because I don't think Toronto Dominion Bank is going to collapse. These are like some of the most well-capitalized banks on the entire planet. Especially the Canadian banks were a lot more strict on handing out loans, but we'll talk about how safe those loans might be and a lot of the fears, right? But first and foremost, take a listen to this. This is BMO's Brian Abelsky, but it was funny because I was listening to this morning, and just take a quick note here. It's kind of entertaining.
So that's why you want to be more concentrated with respect to your holdings, maintain that overweight, let everybody be bearish. If you look at our fund flow chart that we put in our report today, everyone and their mother, brother, sister, cousin, uncles chasing utilities, we'd say good luck with that. Same thing on the staple side, they're expensive. You want to look at where people are not. You want to always want to skate to where the puck is going, Scott, and where the puck is going is these areas.
If the puck is going to a softer portion of the ice because the economy is obviously weakening by virtue of the data, do you really want to skate there at the risk of falling through?
Yes, I do, because remember, stocks lead earnings, which lead the economy. The stock market, if and when we see the softness in the economy, Scott, the Fed's going to cut rates. Karen was amazing when she talked about, and Bryn talked about the Fed's going to be late. Everybody knows the Fed's going to be late. The Fed's going to overshoot. We know that. Scott, what's the market going to do if and when the Fed cuts rates? Come on. We're not in a period where we're going back to zero interest rates anytime soon. Joe talks about disinflation. You have disinflation, from the medium banks, but you also have disinflation from the growth aspects of the market, which would be technology. The market's going to rally the second half of the year. To be talking about the market peaking in the first quarter makes no sense. Are we going to...
So look, this guy is heavy into the banking sector as much as I am. I think they're a huge buying opportunity. I think they're trading at crazy discounts. Yes, there's going to be some short-term pain here, but inevitably banks make more money of high interest loans. Even if they cut rates, that's just going to be another bullish reason for people to feel, oh, the markets are easing up now. We don't have to worry as much. The banks are going to be a little better off because they won't be stressing people out with these higher interest rates. But let's talk about the market data here, why there's some concern, why people are thinking it's the soft portion of the ice, and how bad could the financial system break. Obviously, nobody really knows, but I think there's a lot of concern still around credit card debt in the US that's been pretty much hitting all-time highs coming into January. But in Canada, however, we are seeing credit card debt actually, bleeding off since pretty much November of 2022, which is a pretty good sign. Labor statistics, what's holding up the entire market and what makes this recession so damn confusing is the fact that, typically in periods like this, unemployment goes crazy, and we're seeing a lot of layoffs. I mean, tech companies have been laying off like crazy, but those jobs are getting picked up by other aspects and other sectors of the market, right? Take a look at unemployment or employment here in Statistics Canada actually went up by 0.1%. So the employment's actually been doing pretty well. It's been staying flat, actually trending to the upside. Unemployment rate has actually been completely flat, which is really good. When we take a look at the average weekly earnings here in Canada, and we'll take a look at some of the US data, it's actually jumped up 2.9% over the last 12 months to about almost $1,200 in weekly earnings. You take a look at the US, it sits around 1,141. That's actually going up as well. So there's still a good amount of demand, enough demand in the labor market to see, the average wages continue to rise, which again, in an interest raising environment, cushions some of the blow when we're talking about real estate, because realistically, the raising interest rate environment isn't affecting credit card debt. People who have credit card debt are expecting to be paying massive amounts of this. I mean, whether you're using even a line of credit, which typically already comes with a higher rate, or a credit card in general, which typically has like a 20 to 30% interest rate, that's not what we're talking about when with the general rates. Most of this is relating to the mortgage market, because that's where most of the debt's going to sit and where you're going to see massive swings in what people are paying on their monthly bills. And you take a look at this, to go from basically in Canada, these are the Canadian inflation rates. I mean, could you imagine being around 0.5% here, 0.2% to go all the way over 4%? I mean, you have to think, guys, on a average price of a home here in Ontario where it's $865,000, in Toronto specifically, or the Greater Toronto area, sitting around $1 million. I mean, you got to imagine, even if you put 20% down, you're going to have a mortgage of $800,000. That means your interest payments alone at over 4%, which obviously they're actually a little higher because you're not going to get dead 4%. You're going to be paying around 5%. I mean, you got to think, guys, just do the math. Every 100,000, that's 5, 10, 15, 20, 25, 30, 35. You're paying 40,000 damn dollars in interest. A kid could do this with his fingers in basic math and realize that's absolutely insane. I mean, to be paying just 40,000 in interest before principal, before taxes and insurance and utilities, I mean, you ain't getting a whole lot of, you need to be making real money, and most people in Canada are not making that kind of money. So people are saying that one of two things really have to happen here, like either housing prices have to come down or interest rates have to come down, because the housing market cannot justify this for people putting minimum down payments, which means if you want to buy a house, you need to put a higher down payment, which is what I keep telling you guys, that in the next 6 to 12 months, it's going to probably be a pretty good buying opportunity within most real estate markets, which is why I'm potentially opening up the door for myself to say, hey, if me and my fiance came up with a 50 or even more than that on the down payment, barely taking on a couple $100,000 in a mortgage, buying a condo or something would be probably very feasible. And it's just something that you're going to want to pay attention to, because that's what's going to realistically break the market if we saw a big collapse in mortgages. But it's important to point out that 30% of Canadians actually don't have any debt. They actually own their homes. So it's kind of a balancing act between how bad this is really going to get, considering, again, the jobs market, presuming it stays strong. Personally, I'm seeing it be really resilient even in my own business, which is more marketing related, and typically marketing gets slammed in an environment like this, but I'm actually doing pretty well, and I'll do some more videos on my personal income down the road, or you can support me on Patreon, where I actually do monthly breakdowns of my income. The link to that is down in the description below. But outside of that, so long as you have no debt in this market, to be taking advantage and buying the dips in your favorite ETFs, your favorite stocks, come back to me in the next 3 to 5 years and tell me it was a mistake.